Hi, let's work through amortization as a type of mortgage. Amortized mortgage. Most mortgages are offered based on an amortization schedule of payments. An amortized mortgage provides for a payment that is the same from one month to the next. The amount of the payment covers the principal and interest due for that month. Monthly payment is constant for the term of the mortgage. Amortized mortgages are also referred to as a level payment plan because the amount of combined principal and interest payment remains the same. The amount of the payment applied to the principal increases each month, while the amount applied to the interest decreases. (15 or 30-year mortgages). To determine the set monthly payment amount to cover both principal and interest, a calculation is made on either a 15 or 30-year loan term. An amortization schedule shows the borrower how much of each monthly payment would go towards the interest versus the payment. As more and more payments are made, the balance of the mortgage is killed. Amortizing a level payment plan mortgage. The amount of interest charged each month changes depending upon the amount of unpaid mortgage balance at the start of the month. The unpaid balance, along with the interest rate charged and the set payment amount, determines how much of the payment will go towards principal and how much towards interest. The whole point of the amortized mortgage is for the buyer to have a predictable payment at the start of the loan that the buyer knows will be the payment all the way through the loan. This is an important feature that allows a buyer to budget for the cost of the home and ensures that the home will remain affordable for the buyer. Lenders and buyers like this type of schedule as it reduces the likelihood that a buyer will default on the mortgage. Imagine how stressful it would be for most buyers to go forward with a home purchase if they didn't know what the payment would be in a year, much less 10 years. The reality is that the payment can still fluctuate as it is only the principal and interest that is held constant. The cost of the insurance and taxes that may be paid as part of the mortgage payment can vary from year to year. However, the amortized mortgage gives buyers a huge sense of control over their finances. Notice that in the sample amortization payment schedule, the payment stays the same. The amount paid to interest decreases as the amount paid to principal increases with each payment. The information needed to amortize a mortgage is the beginning principal balance, interest rate, and the scheduled monthly payment. Take the principal balance of the entire unpaid mortgage and multiply by the interest rate. This calculates the annual interest rate. Then take the annual interest and divide by 12 months. This is the amount of monthly interest due for that 1 month. Or this is equal to how much of the monthly payment will go towards the interest payment. Then calculate how much is being paid towards the principal by subtracting the amount of monthly interest from the total payment. The sum equals the amount of money being paid towards that month's total principal, or is equal to the principal payment. Finally, subtract the principal payment from the beginning principal balance to determine how much is now due on the entire mortgage, which will be used to calculate the next month's interest payment. The following formula is used to determine the division of a required payment between principal and interest. It will also produce a new balance. Formula. Beginning principal balance times annual interest rate equals annual interest. Annual interest divided by 12 equals monthly interest due. Scheduled monthly payment minus monthly interest due equals the money paid on the principal. Beginning principal balance minus the money paid on the principal equals the new balance. Story problem. Borrower Connie has a starting balance of $120,000 at the beginning of March. She is being charged a 6% interest rate. Her total monthly payment for combined principal and interest is $842.15. How much of Connie's payment is interest? How much is paid towards the principal? And what will her new balance be at the start of April? Let's answer the first question. How much of Connie's payment is interest? We can take her balance at the beginning of March, which is $120,000, and multiply it by the interest rate. This gives you the annual amount of interest based on that snapshot in time of her mortgage balance of $120,000. So that gives us $7,200. We then immediately divide this by 12, 12 because there are 12 months in the year. And this tells us that in March, Connie needs to pay $600 towards interest. To determine how much of her payment then is principal, we can then take her payment amount of $842.15 and subtract from that the $600, which is the amount she's paying in March towards interest. This leaves $242.15 left to pay towards the principal. Finally, we can take the amount paid towards the balance in March and subtract it from the beginning balance of March of $120,000. So $120,000 minus $242.15 gives us a new balance, which represents the ending balance in March, which is also the beginning balance in April. So to answer our question, what is Connie's new balance in April? We take 120,000 minus 242.15 to give us $119,757.85.